All right, let's just dive right into this explainer. Today, we're going to absolutely demolish the myth that you need thousands of dollars just to look at the stock market. Because honestly, modern technology and micro-investing have completely rewritten the rulebook. We're going to demystify exactly how you can kickstart your investing journey and build a genuinely robust, wealth-generating portfolio starting with just a single $100 bill every month.
Think about your first trip to the gym. Intimidating, right? On day one, your goal isn't to deadlift 400 pounds. It's really just to show up. And investing, it works the exact same way. You just need to start small to build that habit. That first $100 isn't about making you a millionaire overnight. It's about cementing the routine and, crucially, giving compound interest the time it needs to work its absolute magic.
So here's our roadmap for today's explainer. We're looking at the $100 journey, avoiding those common beginner mistakes, choosing your micro-investing app, and understanding the hidden costs and taxes. Then we'll build a boring portfolio and finally unlock the magic of compounding. Moving right into Section 1, the $100 journey, and taking that first step. The biggest game changer here is that you don't need to buy full shares anymore. Let's say a top tech stock is trading at $500. With fractional shares, you can just invest your $100 and own 1/5 of a share. It's that simple. Or you could drop that money into tax-advantaged retirement accounts that have absolutely zero minimums. Feeling a bit more conservative? Money market funds pool high-quality debt for a really stable yield. And of course, there are exchange-traded funds, or ETFs, where you grab a tiny slice of hundreds of companies in a single trade. You've literally got incredible options right at your fingertips.
All right, Section 2, avoiding common beginner mistakes and navigating the pitfalls.
Now, before we get too excited, we have to talk about the traps. Chasing quick wins or waiting for the perfect time to invest. Yeah, those are actually the absolute fastest ways to lose your hard-earned money. First off, investing without a clear goal, like, say, a house or retirement, means you are almost guaranteed to panic the second the market drops. And we see this all the time. Beginners chasing wild rumors on social media for a quick profit, completely ignoring basic risk management. Look, you cannot perfectly time the market. Trying to wait for the absolute bottom to buy is just a fool's errand. As the old saying goes, time in the market always beats timing the market. Always.
Okay, Section 3, choosing your micro-investing app. Let's talk about the right tools.
Looking at the top platforms right now, the great news is they all offer low fees and those vital fractional shares we just talked about. Based on extensive testing, Moomoo actually leads the pack here with a frankly fantastic educational suite and a seriously top-tier mobile app. Then there's Webull, which is highly rated because they offer really great interest rates on any cash you just have sitting around uninvested. And eToro? Well, eToro is a real standout if you want a super seamless setup and their unique social trading features.
But here is the absolutely crucial point. Regardless of which bells and whistles catch your eye, your chosen broker literally must be regulated. Security is non-negotiable. This is what ensures your investments are protected by strict oversight. So always check that the platform answers to top-tier authorities. We're talking the SEC or FINRA in the US or the FCA over in the UK. Seriously, never compromise on your security just for a flashy app interface.
Moving on to Section 4, understanding costs and taxes, the hidden realities.
Let's use India's market as a really excellent global example to show how multiple layers of fees secretly eat into your trades. Because whether you're in New York, London, or Mumbai, you're going to face transaction costs. In India, for instance, you've got your basic discount brokerage fee, right? But then you have to add exchange transaction charges. And on top of that, there's an 18% goods and services tax applied to the brokerages, plus a direct securities transaction tax. All these tiny, seemingly insignificant fractions of a percent, they add up fast. It just means you really have to trade smart.
And speaking of hidden realities, impatient short-term trading is heavily penalized by the tax system. Think about short-term capital gains, or STCG. If you buy a stock and sell it for a profit just a few months later, the government steps in and takes a pretty significant cut, like the flat 15% rate we see in India. Look, when you're only investing $100 a month, giving away 15% of your hard-earned profits right out of the gate, that makes it incredibly difficult to build any real momentum.
On the flip side, holding your investments patiently for over a year is, mathematically speaking, a way smarter strategy for your tax bill. Long-term capital gains taxes, LTCG, are literally designed to reward patience. By simply holding on to your assets for more than a year, your tax burden usually drops significantly,
often down to around 10%. This brilliantly illustrates why consistent long-term micro-investing is so much better than frantic, stressful daily trading. Section 5. Building a boring portfolio and the power of diversification.
Okay, imagine a street vendor. If they only sell sunglasses, a rainy day completely ruins their business, right? And if they only sell umbrellas, a beautiful sunny day is a total disaster. But by selling both, they thrive no matter what the weather does. This is asset allocation and diversification in a nutshell. By buying assets that perform well under totally different market conditions, you completely smooth out your financial ride. You're protecting yourself against major losses simply by not putting all your eggs in one basket.
So here's the thing. While chasing individual trending stocks feels super exciting, like you're predicting the next big winner, it actually carries a very high risk of total loss. Consistently buying boring index funds, however, is the most reliable path to financial independence. An index fund diversifies across thousands of companies. It doesn't try to frantically beat the market, it just matches it for steady growth. It's incredibly boring. And honestly, that is exactly why it wins over the long haul.
Applying these essential risk management rules essentially builds a fortress around your money. By strictly capping your exposure, like never ever risking more than 5 to 10% of your portfolio in one single stock, you completely neutralize the danger of market panic. You also need to match your goals to your assets. Need that cash in a year? Keep it in liquid funds. Saving for retirement decades away? Look at ETFs and equity funds. And finally, make sure you regularly rebalance your portfolio.
And that brings us to Section 6. The magic of compounding, your ultimate reward.
Now, what's really interesting here is this staggering figure, $200,000. This is what your modest $100 monthly investment can become after 30 years of compound growth with an average return. If you just automate that deposit into a boring index fund every single month and reinvest your dividends, you aren't just saving 36 grand over that time. Your money is actually out there making money, snowballing into serious wealth.
But watch this. By simply waiting just 10 more years, letting it sit for a total of 40 years, your wealth more than doubles to over $500,000, over $535,000 to be exact. And that's without you doing any extra heavy lifting. The curve of compound interest, it starts off pretty flat, but given enough time, it goes absolutely vertical. That is the sheer magic and incredible power of starting small right now.
So, armed with this roadmap to regulated platforms, a solid grasp on the tax realities, and the undeniable strength of boring but effective portfolios, you're fully ready to begin. You know exactly how to avoid those beginner traps, and you've seen the astonishing math behind compound growth. The only question left to ask yourself is this: what will your $100 do for you this month? It's time to get started and build that habit. Thanks for joining me, and I'll see you in the next explainer.